Now, South Africa's hospital groups were recently notified they would be the subject of a Competition Commission investigation into practices within the industry. The CEO of Netcare suggested the Commission should investigate pharmaceutical companies as well. So where does this leave the industry? Stanlib Industrials analyst Theo Botha joins us in studio to share his views. Well, let's start right up there. And what do you think is going to unfold from this point, Theo?
Well, I think, it's not the first time that the Competition Commission has looked at the healthcare industry. We just have to put that up front. This is an inquiry into the business practices. So I wouldn't say it's not an aggressive sort of antagonistic approach. It's how does the industry work? Where do the profit drivers come from? Is there enough competition to protect consumers? I think it's more that kind of an approach. And I think when Richard Friedland says the drug companies should also be investigated, I think he's right, because it should be holistic. It should look at all the aspects of healthcare. I think the Competition Commission is probably thinking that because we have SEP regulations in South Africa already, that means that drug pricing is already regulated by government, and they might have thought that means that they shouldn't look at drug companies.
Yes, Theo, I just wanted to come in here and ask you what the single exit pricing actually means for the consumer.
It means that the government sets a price, and that when you go into a pharmacy, a pharmacist can't charge you more than a specified price. They can give you a discount off that price, but they can't charge you more. But that doesn't mean that pharmaceutical companies aren't making very healthy margins. And I think that's the issue that Richard Friedland is referring to, that there's very healthy margins within the pharmaceutical industry still, especially on the private side, and maybe he's kind of thinking that if he adds pharmacy to the mix, then there's a benefit for the hospital companies to pay less for drugs.
Well, it sounds as though it's fair for him to say, listen, don't just look at the hospital groups, also look at the pharmaceuticals.
Yeah.
Do you agree?
I think
it's
that's
not sort of
a fair commentary from his side. Yeah.
Yeah, just to get into some of the companies, I mean, Netcare have now moved this large amount of debt that was sitting within their property portfolio off their balance sheet, as I understand it. How's this going to affect the company's ability to grow earnings going forward?
Well, I think what they've decided is that the property business in the UK, which they are a part owner of, is in such a precarious position that they, in a way, don't think that they should own that business going forward. So they've kind of deconsolidated from their financial statements. And it means that the debt that's within the company, which is basically the repayments are prohibitive. It means that the company, in theory, is not a viable business, and Netcare has kind of walked away from that. That doesn't mean that the OPCO, which is the company that operates the hospitals in these businesses, isn't a good and viable business. So I think Netcare has said, we know, because that's our job, is to operate hospitals, that it's a good business. We like that business, but owning the properties is become too expensive for us, and the debt owners can potentially find new owners for these properties, but we're very happy to still run the hospitals in that business.
So can you rank, in terms of the investment case, can you rank Mediclinic, Netcare and Life Healthcare?
Yes, I'll do that for you. In the Stanlib Industrial Fund, we own Netcare, and we also own Life Healthcare. So Netcare is our preferred choice, and it's really because in their South African business they've still got the most gearing to upside on the operating line, and you're getting the UK business, albeit only the OPCO, basically for free. So we see the best upside in Netcare.
There's about a 33 billion rand market cap on Netcare, is that right?
Yes. And basically that's only valuing the South African business, and it's valuing that South African business at quite a steep discount to Life Healthcare's South African business. So Life Healthcare's South African business is the top rated business.
At about 36 billion rand in market cap.
Yes, and their PE is about 23 times. Netcare's implied PE is below 20 on the South African business. So there's upside there, we think, in Netcare. As I said, we also own Life Healthcare, but I think it's a fully valued business at the moment. I mean, management rating is very high. Investors like them. They've done a very good job. And then Mediclinic, a fantastic business, got a fantastic business in South Africa, in Switzerland, and also in the UAE. But we think it's priced for perfection. So we don't own that at the moment, but I'm not taking anything away from a well-managed business. Yeah.
Just explain to us, Theo, the difference in the offerings. I mean, how do you distinguish between the offerings of Life, Netcare and Mediclinic against one another in the domestic market? Do they pitch themselves at different clients, so to speak, or they have different ways of operating?
They have different strategies. Mediclinic is really focused on top-end surgeons and top-end kind of technology. So for them, it's about when you go to their hospital and you need a procedure, they will have the best technology to assist the surgeon or the physician to do that. And they surround themselves with in that space. I think Life, they all try and do that, but I think Mediclinic does that the best. Life and Netcare is more around where their hospitals are, so to capture the growth nodes, and I think Netcare has probably done the best in terms of that, in terms of being in the right geography. And I think Life Healthcare, they might not have the best kind of geographical representation, but what they've certainly done is they've gone to the funders like Discovery and offered them very good kind of services so that they can attract their customer base to their hospitals, which might not be in the best location. So they've all pitched their businesses slightly differently, but I think Life Healthcare has managed to extract a lot out of their portfolio by having an alliance with the Discovery.
Just in terms of the growth, I just wanted to ask you around, we saw a couple of years ago, probably about 10 years ago, the government introduced the Government Employees Medical Scheme. It was a medical scheme that was growing very quickly. It was offering cover of various types to government employees, right from the lowest salary employees right up the salary scales. Just in terms of the fundamentals, we've got a massive black middle class that's evolving. Is this been a very positive trend for hospital groups?
Well, I think GEMS have really been a lifeline for the hospital industry, because it's created new medical aid lives. It's been really in the last 5 years, I'd say, that has been the growth in medical aid lives. And that's been very beneficial to hospitals. Hospitals need more people on medical aid to really grow the bed nights that they sell. So GEMS has been very positive for that. And then Mediclinic have been very well positioned for GEMS lives. By luck, by fluke, their hospitals have been where government employees have signed up for GEMS, and that's benefited them as well. So
Ilovo came out with results,
Yes.
and the stock's trading around 37 Rand.
yes.
Do you think it is a buy?
No.
Well, there we go, the straight and honest answer.
I think Ilovo, a well-managed business, very good geographical expansion, but I think it's sort of in the price. You can choose between Ilovo and Tongaat, and from where we're sitting now, we'd rather be owners of Tongaat. I think the sugar business within Ilovo has done very well, but Tongaat has invested huge amount of money in growing their cane or the land under cane as well over the last few years, and they haven't really seen the benefit of that.
What about Zimbabwe when it comes to Tongaat? That's an overhang that we need to take cognizance of.
Yes, I think, there is risk around Zimbabwe. We all know that. It makes it a slightly more sobering kind of discussion to talk about Zimbabwe, and the reasons really is because of the unknowns about what the government in Zimbabwe might do. But the reality is that the Zimbabwean assets are very good assets. The management there are doing a lot of work to help indigenized farmers to grow, to have more of them. So they're doing, I think, a splendid job in Zimbabwe for Zimbabweans. But for that, they have to own the asset, and I think it is a good asset. The crane in Zimbabwe is irrigated, which means that it's very good kind of crane. It grows very well. And I think in the share price, we're probably undervaluing the Zimbabwean business right now.
Theo, that's Tongaat specifically obviously makes a lot of money from property development, property sales, and then it's obviously sugarcane. So just give us a split or a vague idea of what the split is in revenues and profits between the two divisions, because that's the way I understand the company.
Yeah, they obviously they sell sugar, and then a part of their business is selling property. So those are properties that are adjacent to growing cities, well, especially Durban, Mhlanga. And as urbanization happens, it's growing into those sugar fields that used to be around the airport. I mean, we all know them when we go down to KZN, we see those sugar fields. And really those properties are sold to developers for housing, for businesses, for hospitals, for shopping centres, etc., etc. It's not a big portion of Tongaat's earnings. I think they made 160 million rand this year out of a total operating profit of over $1 billion, so maybe about 10%. I think the value is not so much in the earnings that comes through every year, although I mean that is important, but it's that real estate. It's sitting there. It's close to a growing node in KZN. So every year, as the Durban municipality grows and the need for land grows, that property becomes worth more, and it's a lot of property. But it doesn't get realized as fast as maybe you want. So they can't sell everything immediately. They are talking about perhaps doing a bulk sale, which might give them in 1 year $1 billion, 2 billion rand of cash flow, which would be very useful to lower their debt. But it's not something that they're going to be getting rid of in a hurry.
Theo, we've got just 1 minute till the end of the show, and in your industrial universe, what is the stock that you are most excited about right now?
Well, the stock that's done the best for us at the moment is Richemont. I mean, Richemont has done phenomenally well, and I think the reason for that is just that they've had kind of the wind behind their backs. I mean, they've been able to sell a lot of watches to people. I mean, contrary to what we might think, there are a lot of wealthy people still investing in luxury goods. And as a Rand shareholder, we've got at the benefit of the Rand behind us. Today there was an announcement that import duties into China will be lifted. That's been a kind of a dark cloud for the luxury good companies in terms of how China is doing. Although the Swiss watch data that was out today wasn't very good for China, I think the outlook for China is very good. So the wind is behind Richemont. I think the share price has run very hard, but that's certainly one of the winners that we've got in our portfolio at the moment.